Welcome to Talk Tickers. Today, we're breaking down SQM's second quarter earnings. Now, on the surface, this looked like a pretty clear miss, but the way the stock traded told a totally different story. So let's get right into it and figure out what's really going on. So here's the big question, the central puzzle we're trying to solve. You have this massive earnings miss, the kind of news that normally tanks a stock. But with SQM, after an initial scare, the stock just bounced back. It showed some serious strength. So what did the big money investors see that the headlines completely missed? That's what we're about to unpack. All right, first things first, let's look at the raw data. And yeah, it's not pretty. The earnings per share, or EPS, came in at just 31 cents. The analysts, they were expecting 52. That's a huge miss. Revenue also came in a little light. And the main reason, the big culprit here, was just really low lithium prices during the quarter. There's no way to sugarcoat this. These are just tough headline numbers. And this, right here, is where things get really interesting. The stock opened way down, gapping below 43 bucks a share, but then, throughout the day, it just clawed its way back. By the closing bell, it was only down about 1.5%, and on some really heavy trading volume, too. You know, that kind of price action, that resilience, it's a huge clue. It tells you the market was digging deeper, looking right past that ugly headline number. So what were they looking at? Well, it all comes down to the fact that SQM isn't just a lithium company. It's really a tale of two very different businesses. While everyone was fixated on the lithium price slump, a completely different part of SQM was absolutely crushing it. And you can see it right here when you look at where the actual profits came from. The Iodine and Derivatives segment was the unsung hero of the quarter. I mean, look at that. It brought in more than half of the company's entire gross profit. This wasn't just helping out a little bit. The iodine business basically put the whole company on its back. And the difference in profitability is just, wow, it's stark. The iodine business was running with these incredible 57% gross margins. 57%. Now compare that to the lithium side, which got squeezed all the way down to about 21%. So you have this incredibly profitable iodine business acting like a massive financial cushion, a shock absorber that allowed the company to just power through the weak spot in the lithium market. Okay, so that's the key. Iodine provided the stability for this quarter. But what really got investors excited was management's story about the next quarter. They spent the entire earnings call explaining why the worst is now in the rearview mirror. And they brought receipts. The CEO, Ricardo Ramos, he came right out and said it. He said they're already seeing lithium prices improve. And that's not some vague, hopeful comment. That is a direct signal from the top, telling the market, hey, those Q2 numbers, that was the bottom. That was the trough. We're on the way back up. And this wasn't just talk. It translated directly into their guidance. They got very specific. For Q3, they said, expect lithium sales volumes to be at least 10% higher, and they expect prices to be higher too. They're seeing really strong demand coming out of China's EV sector and also pointed to a European market that was, in their words, surprisingly strong. And beyond just the next quarter, they laid out this really clear roadmap of catalysts. In July, they hit a huge milestone. Their new Kwinana refinery produced its first batch of battery-grade lithium hydroxide. That's a massive deal because it proves the project works. Then you've got the Codelco partnership deal getting finalized soon, and other big projects are moving ahead. This is a story about execution. Okay, so let's put it all together. You've got the super strong iodine business holding down the fort. You have a lithium market that looks like it's already turned a corner. And you have a clear pipeline of growth projects. So, what does that mean for the next quarter? Here's our official call. We are calling for a beat. We think SQM is going to beat analyst expectations next quarter. Look, management guided for higher volumes and higher prices. Frankly, that sets a pretty low bar for them to clear, especially with lithium spot prices firming up. It's a setup for an upside surprise. We think that beat is going to fuel a continued recovery for the stock. The whole story here is shifting. It's no longer about how bad are earnings. It's becoming a story about how much money can they make as lithium prices recover. With catalysts like the Kwinana ramp-up coming online, the path of least resistance looks higher. And because of all of this, our official rating on the stock is outperform. You've got this strong, diversified foundation combined with clear growth drivers right around the corner. We think that gives SQM the potential to really lead its peer group and the broader market. All right, let's have a little fun. We're going to switch gears for a second and throw out a more speculative idea, something you might hear kicked around in a hedge fund meeting. how could an investor try to play this very specific SQM story? You could think about what's called a pair trade. So step 1, you buy SQM stock. You're betting on the company's specific stuff we just talked about, the Kwinana project, the strength in iodine. But then for step 2, you hedge that bet by selling call options on a broad lithium ETF, something like LIT. The logic is simple. You're not just betting that lithium goes up. You're betting that SQM, because of its unique strengths, will outperform the rest of the lithium sector. It's a bet on SQM being the best horse in the race. So there you have it. While the headlines screamed earnings mess, the real story was one of hidden strength and a clear path forward. The big question now is, can SQM's execution keep it ahead of the pack as the lithium market gets back on its feet? As always, you should do your own research. This is not financial advice.